You find a condo that looks like an absolute home run. The purchase price is low, the location is great, and you don't even have to worry about mowing the lawn or fixing the roof. But then, you hand the HOA documents over to your lender. Suddenly, your lender is throwing around terms like non-warrantable, pending litigation, and concentration limits, and your easy deal turns into an absolute nightmare. So, should investors just avoid condos altogether? Today, we are tackling condos and DSCR loans. Yes, they are complex, but they are also a highly workable and potentially profitable option if you know the rules of the game. We are going to break down the dreaded condo questionnaire, explain the critical difference between warrantable and non-warrantable, and show you exactly how to get these tricky deals funded. Condominiums are a common target for real estate investors seeking to operate in high-density markets or enter price-sensitive metro areas where detached homes may be cost-prohibitive. DSCR loans can be an effective financing option for condo units, but investors should be aware that condos are subject to more complex underwriting than other property types, including additional project-level reviews, additional insurance requirements, and eligibility rules. Note that project is the real estate terminology for the condo building or total group of units that fall under the same condominium board or HOA. For DSCR loans secured by condo units, interest rates will likely be a bit higher, although only mildly, like 0.25% to 0.75%. And LTV maximums will also likely be slightly lower, such as maximums of 70% or 75% versus the standard maximums of 80% or 85% for DSCR loans for SFRs or PUD properties. While condos are generally eligible under DSCR loan programs, presence of a homeowners association or HOA, shared legal structure, and project-wide risks mean DSCR lenders apply a higher level of scrutiny compared to financing a single-family rental, townhome, or even a 2 to 4 unit property. General condo eligibility for DSCR loans. To qualify for a DSCR loan, a condo unit will typically have similar requirements as other property types, such as fully residential in nature, being in good condition, and containing a minimum of 500 square feet of living space. The key differentiator for DSCR loans secured by condos is the qualification of the condo project in full, in addition to the standard property qualification requirements for the individual unit. The condo project will be evaluated by both the DSCR lender and the appraiser, with the lender mostly relying on a document called a condo questionnaire to evaluate additional risks that come with lending on condo units. One key condo classification is whether the condo unit is deemed to be warrantable or non-warrantable. So what is warrantable versus non-warrantable when it comes to condos? This bifurcation refers to whether the unit is eligible for conventional loans, meaning do they satisfy Fannie Mae guidelines, where warrantable simply means it's eligible for conventional loans, while non-warrantable means it's not. For a condo unit deemed warrantable, it generally has to be free from several types of elevated project-level risk factors that could heighten the risk for a lender. These risk areas typically include areas such as condo project financial health, meaning its budget and reserves, HOA dues delinquency rates, and so on, building or shared space conditions, such as a potential for needed capital improvements or special assessments, proper insurance coverage, and any other potentially damaging issues, such as ongoing litigation, owner or investor concentrations, or zoning and legal hurdles. While DSCR loans are obviously not conventional loans and follow proprietary rules and guidelines, not Fannie Mae rules, the warrantable versus non-warrantable classification can come into play for some DSCR lenders. Most DSCR lenders will offer DSCR loans on both warrantable and non-warrantable condo units, with no difference in qualification and pricing, or what types of rate and fees you'll get. However, some lenders may have slightly different standards for non-warrantable units, such as 5% lower LTV maximums or marginally higher rates like 25 basis points. All condo units will be subject to baseline rules on eligibility for DSCR loans, regardless of warrantability. While unlike conventional loan programs, what may make a condo unit ineligible for a DSCR loan will vary from lender to lender. The following rules will generally apply. First, lenders look closely at the ownership structure. If more than 50% of the units are owned or permitted to be owned by investors, lenders get nervous. While DSCR lenders expect higher investor concentration, extreme imbalances can lead to weaker upkeep standards, higher turnover, and less long-term commitment from owners, which reduces the stability of the building. Similarly, if one person, entity, or related group owns more than 20% of the units, that's a red flag. If that one major owner defaults on their dues, it could completely destabilize the HOA's budget and put too much control in one party's hands. And if you're buying in a new project, lenders generally require that at least 90% of the units are sold and legally conveyed to non-developer owners. High unsold inventory raises financial stability concerns, and if a developer is struggling to sell, they might liquidate the remaining units at fire sale prices, crashing the value of your property. Next, lenders scrutinize the HOA's financials. If more than 10 to 15% of the units in the building are 60 or more days past due on their HOA dues, you have a problem. Furthermore, if more than 10% of the HOA's total annual budget in dollar terms is delinquent, the loan will likely be denied. Why does this matter? Because when your neighbors don't pay, the HOA still has bills. That usually means higher dues for the non-delinquent owners, reduced building services, or deferred maintenance. Then there are the physical and legal risks. Significant pending litigation involving the HOA over structural, safety, or habitability issues signals potentially massive repair costs and insurance complications. Minor litigation might slide by with a letter of explanation, but major lawsuits are often a deal breaker. Lenders also look at the physical upkeep. Any significant deferred maintenance, generally anything over $2,000 and need repairs, signals current or future strain on the building, which can trigger a special assessment. Also, does the building have a lot of retail space? If more than 20% to 30% of the total square footage is used for commercial purposes, lenders view it as an economic risk tied to the business performance rather than housing stability. Finally, the number one thing that kills condo deals at the 11th hour: insurance gaps. The HOA's master policy must cover 100% of the replacement cost, have deductibles generally under 10%, and include flood insurance if required. Inadequate master coverage means the cost of rebuilding gets shifted to the owners. General liability coverage for the common areas needs to be at least $1 million per occurrence and $2 million in aggregate frequency. Plus, for projects with more than 20 units, there typically must be Fidelity or crime insurance covering at least 3 months of the total HOA dues to protect against theft or embezzlement. And don't forget your own unit. If the master policy excludes interior improvements, you must obtain your own HO6 walls-in policy with a deductible under 5%. Without it, you can be on the hook for incredibly costly interior repairs if a loss occurs. Next, let's look specifically at Florida condos, which may need extra requirements and caution. But before we talk about the specifics of DSCR loans for condos in the Sunshine State, if you're finding this helpful, make sure to hit that subscribe button. And be sure to check out the description below for a link to our full DSCR loans guide and even more details. Florida's condo market has seen significant changes in recent years due to a combination of factors: aging building stock, rising insurance costs, and updated safety regulations following highly publicized structural failures. As a result, many DSCR lenders have tightened eligibility criteria and added restrictions for condo units in Florida specifically. The collapse of the Surfside condominium tower in 2021 spurred many lenders to focus on Florida condos when evaluating the risk of DSCR loans for condo units. Additionally, state regulators added additional rules in 2022 through Florida Statute 553899, requiring many condo buildings, especially older projects and those near the coast, to undergo additional structural inspections, maintenance, and capital expenditure requirements to satisfy the new safety rules. Many observers forecasted likely large-scale cost increase for Florida condo unit owners in the form of special assessments and increased HOA dues, and those predictions have mostly come true. Additionally, in recent years, property insurance rates have spiked in Florida, as the state often sits in the crosshairs of potentially damaging hurricanes. All of these risk factors have created a perfect storm of increased risks for condo unit owners and lenders, including DSCR lenders that provide financing for them. The value of these condo units are deeply impacted by these factors, as increased risks of special assessments and higher HOA and property insurance costs lead directly to depressed values of ownership. Since DSCR lenders look at the valuation of the collateral through the LTV ratio very closely, eligibility and loan terms have been tightened for DSCR loans on condo units in the Sunshine State for many lenders. While most DSCR lenders have not responded by making Florida condo units ineligible, they have typically chosen instead to lower LTV maximums, such as 65% or 75% instead of up to 80%, require additional documentation and confirmations of recent structural inspections, and worsened pricing for these loans, such as charging higher interest rates and/or fees. But this is a relatively recent trend among DSCR lenders, and treatment will likely vary significantly from lender to lender, with some not taking the step to restrict eligibility or pricing on condo units in the state at all. And that's it. That's all we got for now for the guide to DSCR loans for condos. If you want to learn more, head over to harpooncapital.com and fill out our Contact Us form. When you do, we'll send you our completely free ebook, 10 obstacles for DSCR loans and how to overcome them. And don't forget to like this video, subscribe to the channel, and check out the description below for all of the links we mentioned today. Happy investing, and we'll see you in the next video where we'll cover property condition requirements for DSCR loans. See you next time.